The Strait of Messina lies between Sicily and Calabria. In Greek mythology, Homer wrote about Odysseus's dilemma as he tried to cross the strait. Two sea monsters, Scylla and Charybdis, lived on opposite sides of the water. Scylla was a six-headed monster who ate 6 sailors of any ship that came close. Charybdis had an uncontrollable thirst for the sea, causing whirlpools as she drank the water. They posed an insurmountable threat because avoiding Charybdis meant passing too close to Scylla, and avoiding Scylla meant getting too close to Charybdis. The SECURE Act creates a similar problem for investors with large IRAs. At one end of the strait is Scylla, the monster that forces your non-spousal heirs to pay income tax on your IRA no later than the end of the 10th year after you pass away. You may steer clear of Scylla by using a charitable trust for your IRA beneficiaries. While it eliminates the tax and provides more income to your beneficiaries during their lifetime, you will confront Charybdis on the other side. The whirlpool will take your entire IRA as it goes to a charity after the beneficiary passes away, leaving nothing for grandchildren or others you would have liked to share the unused portion with. The key to avoiding Scylla and Charybdis lies in the DTC IRA Replacement Trust. This trust replaces some or all of the assets lost to taxes or charity through an Irrevocable Life Insurance Trust, or ILIT. A life insurance policy is purchased, and the ILIT becomes both the owner and the beneficiary of the policy. This creates tax-efficient assets free of estate, income, and capital gains tax. Let's examine 2 hypothetical examples. Case Study 1. Pay the tax. A mother wants to leave her IRA to her child and maximize the income her child receives. When her child passes away, she wants any unused assets to go to her grandchild. Step 1. Name the child the beneficiary of the IRA. Step 2. Purchase life insurance on mom's life. Step 3. Establish an Irrevocable Life Insurance Trust through the DTC IRA Replacement Trust. Step 4. The daughter receives the IRA and pays the high income tax. However, the DTC IRA Replacement Trust replaces some or all of the assets lost to taxation, resulting in more income for the daughter. Step 5. When the daughter passes away, the remaining assets are distributed to the grandchild. In this scenario, mom and her financial advisor steer the ship close to Scylla. The multi-headed monster took a large chunk of mom's IRA, but these sailors were partially or fully replaced by the DTC IRA Replacement Trust. Case Study 2. Eliminate the tax through a DTC IRA Charitable Trust. A father plans to leave his IRA to his child and wants to eliminate the SECURE Act tax. He would like to gift any remaining assets to his donor-advised fund after his child passes away. However, he is upset there will be nothing left for his grandchildren. Step 1. Dad establishes a DTC IRA Charitable Trust. Step 2. Dad names the child income beneficiary of the trust and the donor-advised fund as the remainder beneficiary. Step 3. Dad names the charitable trust as the beneficiary of his IRA. Step 4. Dad establishes a DTC IRA Replacement Trust. He places the life insurance on his son and names his grandchildren as beneficiaries of the trust. Step 5. When Dad passes away, the assets pass to the DTC IRA Charitable Trust, eliminating the SECURE Act tax, providing more lifetime income to his son, and giving Dad's estate a tax deduction. Step 6. When the son passes away, the remaining assets are gifted to the donor-advised fund. Step 7. At the same time, the life insurance placed on the son is paid to the replacement trust. The trust passes those assets to the grandchildren free of estate, income, or capital gains tax. In this scenario, Dad and his financial advisor chose to steer away from Scylla, and the IRA was engulfed by Charybdis. However, the assets that went to the donor-advised fund were partially or fully replaced by the DTC IRA Replacement Trust. Your IRA is far too important an asset to have casual planning. Your financial advisor, along with Dunham Trust Company, can help you navigate these treacherous straits. Contact Dunham to learn more about replacing assets that were lost to the SECURE Act tax or given to a charity or donor-advised fund. Please subscribe to our channel for more Dunham insights.